Well, hello, everybody, and welcome to our inaugural webinar, our Q1 2026 market update webinar. This is our first one of the year, and I think for all of our clients that are tuning in on the Crystal Coast, we survived Snowmageddon. At least what we thought a week ago was going to happen did not, so that's kind of nice. And I look outside. Beautiful downtown Morehead City. It's overcast, probably 40 degrees. How is it in Okinawa, Japan, Tara?
Good question. Well, the sun's not up yet, but we'll be soon. We're definitely not getting snow. We're still swimming here. So
Yeah,
70s, yeah,
well, that is
70s.
great. Well, proper introductions. My name is Greg Patterson. I'm joined with my colleagues, Tara Gould, Jen Mann, and J.A. Kennedy, and we are all with Atlantic Wealth Management here in beautiful downtown Morehead City. We thank you for joining us today. As I mentioned, this is our kickoff to the year. We do these webinars each quarter to bring you timely market updates and actionable items that you can take action on for the betterment of your financial future. And so today we're going to take a look at several things. We've got 30 to 40 minutes to talk through this, so it's going to be action-packed. We're going to talk about 2025 market performance. We had a terrific year, the third banner year for the S&P 500, and we'll break that down. We're also going to look at 2026 economic outlook. We're going to talk through New Year financial planning topics that you should know and take action on. We're going to talk through tax season preparation that does start today, January 26th. And then we're going to cover some action items, key takeaways from the call, and we'll wrap all this up with a conclusion and send you on your way this afternoon. So with that, I'm going to turn it over to my colleague, Jen Mann, to talk us through 2025 asset class returns. Jen, what you got for us today?
All right. Well, any of you who have been on a prior webinar with us, you may recognize this chart. It's one of our favorites, and it's one we'll revisit quite frequently during our webinars. It's known as an annual asset class return chart. And we like this chart not only because of its visual appeal, obviously, I personally love the beautiful colors, but because of what it continues to show us. So this chart outlines the performance of 9 different asset classes over the last 15 years. So for the time period 2011 to now 2025. Along with a diversified portfolio, rebalanced annually, which is the white box that you see in the middle there. We'll call that asset allocation, as you can see. So what we see is that in any given year, it's particularly difficult to determine which asset class is going to come out on top and outperform all the others, and which asset class will underperform and find itself at the bottom of the ranking. The saying you'll often hear in our industry is past performance is not indicative of future results. And as you can see from this chart, that can often be the case. So it's not uncommon to see sizable swings in some asset classes. So let's take a look at commodities, for example. So commodities had a tough run during the 2012 to 2015 timeframe. You could see them at the bottom there. But in 2022, commodities came out a winner with an average return of 16.1%. In 2023, back to the bottom it goes with a return of negative 7.9%. So that's quite a swing. Hindsight, of course, is 2020. So now that we're well into 2026, we're able to look back and see our winners for 2025. So emerging market equity took the #1 spot, up 34.4%, and right behind it, developed market equity, which excludes the US and Canada, was up 31.9%, followed by large cap, or the S&P 500, which measures the large cap segment of the US equity market. That was up 17.9%. In 2025, fixed income, cash, and REITs were the 3 lowest performing asset classes, but all 3 were still in positive territory. So over the long term, we can see that being invested in a diversified portfolio that's rebalanced periodically, like we do here. Again, that's illustrated by our white asset allocation box you'll see there in the middle. It's beneficial because it truly helps smooth out some of those big swings that we might see otherwise. And any of you know us know that one of our firm's 6 core values is consistency. And when it comes to our investment philosophy, we do believe that consistency is key. We'll always say time-tested principles such as the importance of diversification, strategic positioning in quality investments that align with your investment objectives, and regular rebalancing. Those will always be at the heart of what we do here in our investment management process, not only in 2026, but beyond.
That's great. Thank you.
Thanks, Jen. That was very well said.
Yep.
This slide, I'm going to talk about this slide. It pulls together two important ideas, how different parts of the market have performed over time and how expensive, inexpensive they look today based on earnings. So you'll see across the top, value, blend, and growth, and then down the side, large, mid, small. Value companies tend to be more established, dividend-oriented. Growth companies typically reinvest heavily for expansion. Blend sits right in the middle. So I want to start on the upper left. This shows the annualized returns over the last 10 years. You can see that large cap growth has led over that time, followed by large blend and large value. This explains why growth stocks have gotten so much attention in recent years. But notice that all areas of the market posted strong long-term returns, which reinforces why, what Jim was just talking about before, why diversification matters. Next, you'll see calendar 2025 returns. Again, growth performed well, especially among large companies. Mid-cap slightly lagged, small cap somewhat. The lower left returns show since market peak in early 2022. This period includes a significant market pullback. We remember those well, and the recovery that followed. Growth stocks, as you can see, fell more during that downturn, but they rebounded faster coming off the bottom, which explains those large numbers here. And then next to that, you'll see the performance since market bottom of October 2022. Again, growth led the recovery by a wide margin, particularly in large companies. So now I'm going to move over to the right, which looks at valuations. Forward price to earnings, or you'll hear PE, compares today's stock prices to what analysts expect. So looking forward, what analysts expect companies to earn over the next 12 months. Each box shows today's valuation versus the long-term average over the last 20 years. Growth stocks currently trade at higher multiples than their historical norms. I'll talk about that a little bit more in a second. While value stocks, so remember those dividend payers, are closer to their long-term averages. In this bottom section, what we're doing is we're taking those valuations and we're turning them to percentages. Where you see a percentage over 100%, that typically means it's above the historical average. And so you can see that on large cap growth, this is of course well above the norm, which I mentioned earlier, while those value stocks are a little bit closer to average. This does not mean that markets are about to fall, but it does suggest to us that future returns may depend more heavily on earnings growth rather than valuation expansion. I'll reiterate what Jen said before. This is why, all of that to be said, this is why portfolio construction is important, because we want that exposure to growth so portfolios can keep pace with inflation, outpace inflation. But we also want that balance with value stocks, with the dividend payers, and also fixed income to support income needs and manage volatility. We're not going to try and guess which box will lead next year, as Jen mentioned, on asset classes. Our approach is we're going to stay diversified, we're going to rebalance, and I think Greg or JA may mention this a little bit later on rebalancing, If one area runs far ahead, we'll rebalance back to target so that your portfolio stays aligned with your long-term plan.
It's a great point, Tara. Because of the numbers there, you can see if we don't do that, the growth in good times
Right.
would perform better, and we inherently get more risky if we don't rebalance back to our risk targets. So,
Exactly.
especially for those that are retired or have a more conservative slant or tilt, we want to be sure to do that.
Absolutely.
Well, thank you, Tara. And as we take a look at the market outlook for this year, JA will be breaking down the economic fundamentals on the next slide. But just to let you know, we came off of a rapid 4.4% annualized rate for real GDP in the third quarter. It's the fastest quarterly pace in 2 years, and we have had 3 blockbuster years in the U.S. equity market. So we think economic growth is accelerating modestly. The Fed meets this Wednesday, and the probability of no change in interest rates is at 97.2%. So no one should expect an interest rate cut. However, the market is pricing in interest rate cuts for this year, and we think that would hold, likely giving a strong indication that the growth in the economy continues. I also want to say the strong investor risk appetite is out there still. There's large amounts of cash that's still sidelined. So we see this coming into the economy and helping with that growth. The second point I'd like to make is that equities are likely to end the year. This is the S&P 500 US equities. We see them being somewhere in that 7,000 to 7,400 range. More specifically, most economists think that will end up on the side of the 7,400. So growth over where we are today, a little above 6,900 on the S&P 500 right now. And then lastly, as we think about corporate credit and short duration, we think there will be benefit from strong fundamentals and declining interest rates this year. The consensus among economists is that the Treasury on the 10-year will stay at 4.2%. It's right now at 4.21 today. But we think that yields may dip mid-year on Fed cuts. We'll know more, of course, as we get into the year, with the only economic indicator being employment that looks to be softening on the new job creation. Median Wall Street target, as I mentioned, is somewhere between 74 and 7,500. So that likely looks good for those of us who own stocks in a well-balanced portfolio. JA, can you carry that forward with the economic outlook based on the fundamentals?
Definitely. Yep. So if you've been on one of our webinars before, we like to not get into the nitty gritty, but kind of provide a general backdrop of what the economy looks like and what to expect going forward. And we do that across several different areas. This graphic looks familiar. We've used it before, but just jumping into consumer spending, retail sales is one of the ways in which we measure that. And nothing to be concerned about when we look at the trend on retail sales. The latest number had retail sales up over 3%, 3.3% year over year, which is a healthy level. So we can check the box off there. Employment, Greg mentioned, the unemployment rate did tick down slightly in the last report. So it went down from 4.4% to 4.2%, but the number of new jobs created was lower. So it was only in the 50,000 or 50,000 job range, whereas we've had much higher months if we look back over time. So that's something we'll continue to pay attention to. If we look at personal income and spending, again, no real red flags or yellow flags here. Consumer spending and personal income have both increased as we look over the last year. in the four, I think both are in excess of 4% year over year increases, which we would say are healthy rates of growth. Fed rates, Greg already mentioned this, the expectations on rate cuts going into this year. The exact timing of those, we don't know, but the consensus seems to be we may get 1, 2, or 3 rate cuts. So if we take the average of that, maybe a couple rate cuts, 25 basis point rate cuts, and we'll touch on that in a bit, a couple slides down the road on what that looks like, what that means for bonds and fixed income. The housing market, with rates decreasing slightly, we have seen some movement there. Existing home sales have picked up a bit, whereas there were people sticking in their homes with low rate mortgages. We've seen some movement there, and new home sales have continued in a positive trend. So we would expect that to continue, especially if we see another couple of rate cuts from the Fed. And then GDP, Greg mentioned the latest number. If we go back in time just for a bit, we started the year off a year ago, first quarter of 2025, we actually had a negative GDP number come out. So that was negative 0.6%. It wasn't drastically negative, but it was negative. We recovered with a positive number in the second quarter, and third quarter was at 3.8%. 3.8% was the second quarter. Third quarter was 4.4%. And then the data is delayed a bit for the fourth quarter. If you'll remember, it seems like quite some time ago, but it wasn't that long ago. We had a government shutdown, and so we're still catching up on the timing on some of this data reporting. The expectations are that we finished 2025 with definitely a positive GDP. The range is between 2.5% to 4% for fourth quarter forecast that I've looked at. And then for 2026, we would expect another positive year, all things being equal. There are always risks and things unexpected that can pop up, but given this economic backdrop, we feel like we can have another positive year, probably in the 2 to 3% range on GDP annualized growth, 2.5%, somewhere around there. And then we've included or kept inflation in the center of all this because that is still a big area of focus. The CPI, or Consumer Price Index, currently is right at 2.7%. So that means from a year ago, prices have, on the whole, on the average, increased 2.7%. This is within kind of our long-term inflation expectations, what we build into our financial plan. So not a concern here, and we kind of have projected out to stay in that 2 to 3% range for this year. So that's kind of high level overview, just touching base on these different points and areas that we are paying attention to. The only other thing that's not on here would be industrial production, manufacturing. Industrial production has increased a little bit over the last few months. Manufacturing has still been sluggish, so we'll continue to pay attention to those two areas as well. Anything to add there, Tara, Jen, Greg?
No,
Consumer
you got
sentiment.
it. You got it for sure.
I think consumer
So-
sentiment's up.
Yeah.
Yeah, people are feeling a little better about things to start the year.
56.4 was what it rose to this week. So that's good.
Yep.
Very good. All right. I'm going to talk about equity, and then I'm going to kick it back to JA, just talk about fixed income. This first slide that we're looking at summarizes consensus expectation for earnings growth, and this is cumulative growth over 26 to 27 period across different segments. Keep in mind, this is the aggregate earnings expectations, not a price forecast, and of course it's subject to revision. What I'll point out is Russell 2000 growth is showing the highest expected earnings growth. This is for small cap companies. They tend to have higher operating leverage, meaning incremental revenue growth, which can translate into outsized profit expansion. They're also more cyclical and more sensitive to economic reacceleration, the easier financial conditions and something we talked about earlier, which is potential decline of interest rates. The trade-off here is that small cap, small growth is historically more volatile. If we shift over to the right a little bit for large cap, so for large cap benchmarks, you'll see the S&P 500 as well as the Russell 1000. Still expected growth, but a little bit more moderate. These businesses tend to be maybe more mature with more stable margins. And expectations for 2026, 2027 are a little bit more moderate. Next. This shows sectors. And what you can see is information technology, IT, still sits at the top of the chart for expectations. So we're talking specifically AI, semiconductor, cloud migration, enterprise automation, all having impact on IT this year. I'll talk about a few others. So next, industrials the growth reflects expectations for continued infrastructure spending, aerospace demand and automation. For consumer discretionary, these earnings depend on real wage growth, the employment levels, and credit availability. So we're paying attention highly to this sector. A few over is financials. So think interest margins, what's the loan demand, deposits, and credit quality. Healthcare, utilities. Utilities tend to be sensitive to rate levels and regulatory frameworks. And when we're looking at the lower earnings forecast, it doesn't imply or say that these are unattractive sectors. We tend to look to these sectors to maybe not provide the highest level of growth, but for that consistent dividend income. When we see sectors drift, so example for IT, if we see IT have a large growth year, that's when we would rebalance back to target.
One other area I wanted to highlight, Tara, we had a question come in from a client about the energy sector, especially with AI and the need for power, data centers, electricity.
Absolutely.
And if areas like nuclear, renewables, liquid natural gas, those things in the energy sector would be areas prone to do well. And this was kind of suggest that if we look at energy being in the top three.
Yeah.
And just looking at our current portfolio allocations, we are slightly overweight in the energy sector currently. So wanted to address that.
Absolutely.
Okay, and that brings us to fixed income outlook. When we say fixed income, we mean bonds. It's just another way of saying bonds. And this slide here, where we want to take a look at, given the expectations of reduced rates this year, thinking that the Fed may reduce rates a couple times, about 25 basis point cuts. What can we expect from the bond sector, from fixed income? And you can see two colors here, the dark blue and then the aqua, we'll call it aqua. The dark blue is what bonds have done across these different types of maturities in areas where we've seen 1% rise in yields. That's the dark blue. The aqua is 1% fall in yields. So focus on the aqua for the sake of the expectations this year. Unless things change, we would expect the trend to be downward in terms of rates. And so we're not in the negative realm, we're in the positive realm. If we throw on top of that we've got decent yields in the market already, things would look like they will bode well for bonds or fixed income this year. Anything I missed on that, Tara?
That's good.
And then kind of to add to that, when we look at bonds, there are all different areas, just like stocks, we can invest in growth or value, large companies, small companies, mid-sized companies. We can invest in debt or fixed income investments that are long-term in duration, short-term in duration, or in between. And based on where we are, we've communicated about economic backdrop and expectations on GDP, we would expect to be in between this below to near normal GDP growth and near normal inflation. So that inflation, think about that 2 to 3% target on the CPI. GDP, kind of similar, 2 to 3% on GDP growth. That drives our allocations in our portfolios, our more conservative portfolios in the fixed income that would be more focused on fixed income. We want to be invested across both short-term and intermediate, and even in our moderate portfolios to have the balance between the short and intermediate duration fixed income.
Beautifully said. So up until now, we've talked about markets, market expectations, sector dynamics. I want to shift into talking about financial planning and actions we want to focus on at the start of each year. So let's start with cash flow. Remembering to review your spending patterns, knowing what your cash flow is coming in, maybe required minimum distributions, income, and cash reserve accounts. Maintaining planned spending in cash or maybe short-term bonds, but maybe cash is going to help reduce the need to sell equities potentially during a market downturn. So what I mean by that is taking a look forward, looking at your spending for the year and communicating with us if there is maybe a cash need that we could be mindful of generating cash and keeping that in a reserve account until you need the funds in order to pay for what you've decided to do. Retirement contributions. So if you're still working, maybe partially retired, we want to review your contributions to your employer plan. As part of our rebalance communication, we asked if you have a 401k, 403b, some sort of employer plan, please send in a copy of that for us to review along with your investment allocation options. And we'll come back to you with a recommendation if needed to make any adjustments. Same thing with maybe you're retiring this year. We want to take a look at pension elections, survivor benefit options, contribution decisions. So this is a common conversation. Should I be contributing to a traditional account or a Roth account? And so those decisions do require a little bit longer conversation, but focused around tax bracket, so tax income, long-term goals, and maybe even estate or legacy goals. Tax planning, Jen will talk about some tax prep in just a moment, but I just want to remind everyone, tax planning is ongoing, not just something that's done in April. So that's the big tax push to get your returns done, but keeping in mind that we're looking at tax planning throughout the course of a year. Maybe it's a Roth conversion. Maybe it's a charitable strategy, like a qualified charitable distribution, which we can send funds directly from your IRA to your charity of choice. Capital gains harvesting, so we'll communicate that with you. Coordination of withdrawals, if it's best to take money out of a taxable account or a tax deferred account. For investment portfolio review, we'll constantly revisit asset allocation, diversification, rebalancing. We said that a few times. We'll review your sector, style exposure, income sources, duration in bonds, which is what JA was just talking about, and concentration risk. Keeping in mind, though, of the things we talk about, your portfolios are assessed relative to your retirement goals and retirement spending plan rather than just to a market benchmark alone. Your portfolio is going to be customized to your specific plan. If I have anyone on today that has equity comp, we want to talk about your stock options, make a plan for your restricted stock, your ESPP, that employer stock plan. We want to review those vesting schedules and be able to model out for this year and for the coming years, exercise and sales strategies. For insurance and risk management, I think everyone would agree, is a cornerstone of financial planning. We want to review your policies, whether it's a long-term insurance policy, what a liability coverage, homeowners insurance, auto insurance, and also life insurance. And the goal here with insurance is to create a plan for those low probability events, but high impact, meaning that they're going to have a high impact on your overall plan. Next, estate planning and beneficiaries. Let's review your will. Trust, powers of attorney. Do we need to make any updates to your beneficiary designations on your retirement accounts, your insurance policies, anything like that? With estate planning and beneficiaries, I want to highlight there's been some regulatory changes specifically around inherited retirement accounts. So this is something that we're highlighting with clients, that this review is very critical. For required minimum distributions, we're going to communicate that with you. This is usually front and center for our clients. We'll review the RMD amounts withholding, so you can withhold taxes on your required minimum distribution, and just coordinate that with your portfolio withdrawals. And the goal here to fund spending to meet those requirements while managing what we can as far as lifetime tax exposure. College and family planning, so maybe even where you are today in retirement, family planning still continues. So let's have a conversation around grandchildren and grandchildren's education, maybe some gifting strategies, Education 529 funding, and maybe even a charitable legacy. Debt and credit strategy. Here I highlight any maybe mortgage balance, HELOCs, line of credit, and interest rates. In higher rate environments, we often have the conversation of, should I pay down this debt? Usually the conversation's around mortgage. I think you guys can agree with this. Should I pay down my mortgage? Should I take money out of my investment account to pay down my mortgage? Should I leave it where it's at? This is, again, a conversation we want to have with you. And we do want you to have access to liquidity. And then lastly, the goal check-in. We want to revisit your goals. Life, when we do financial planning, we always say this is not a static plan. Life is not static. Spending changes, patterns change, health considerations change, maybe your family priorities. And we want to make sure we update those projections so that we can adjust our strategies so that your plan is aligned with what you want to do and what matters most to you.
Very good, Tara.
Thanks, Tara.
You're welcome.
All right, so tax time preparation. So happy opening day, everyone. Of course, it's too early for me to be talking about baseball season. So instead, we're talking about tax season. So today is the day that the IRS began accepting and processing 2025 federal tax returns. So big day. But we wanted to cover this. Obviously, the tax deadline this year is April 15th. And of course, for anyone who will be filing an extension, October 15th is your day. That's the deadline. So as we gear up for tax season, obviously, we wanted to provide everyone with some helpful hints that we hope will help take some of the stress out of the prep work, because we know sometimes it can be a bit of a stressful season. So we've just got some bullets here to keep in mind. So start early. Begin gathering your tax documentation as soon as you can. I've had one or two clients reach out. They're already getting their forms 1099-R. Those are the forms from us that will outline any distributions from retirement plans. Most of your non-qualified accounts or brokerage 1099s, those will start coming here in the next couple of weeks, early to mid-February. And for anyone who receives K1s, we know those can often be the stragglers, coming a little closer to tax time, sometimes even after, depending on the investment. But whenever things start to roll in, go ahead, set them aside. Looking at the next bullet, we'll often say create one central folder. Quite a few of us get our tax preparation guide from our CPA. So if you receive things in hard copy, sock them away in there. If you receive anything via e-delivery or electronically, find a good place on your laptop or your iPad to put those things so you know exactly where to find it all. We often recommend separating sections for income, investments, charitable, put everything in a nice organized manner. That'll make it a lot easier for the CPA to go through. When in doubt, include it. So this is a big one. If you don't need it, that's okay. But if you do, you'll be glad you put it in there. So we'll often say, make sure you've got all your W-2s, all your 1099s, any SSA 1099s. Even if it's an account that generated a small amount of interest, if you got something reporting that small amount, include that. Any closed accounts, any documents that may come in for closed accounts, rollovers that took place in the preceding year, put all those same place, same binder. Anything, if it's not needed, it can be filtered out, but if it is needed, we want to make sure it's there. Any life changes that have taken place in the previous year. So marriages, divorces, if you have new dependents, if there have been job changes, if you retired, if you had any kind of property purchases or sales. And obviously, if you relocated states, as an example, want to make sure you note any of those and make sure you relay those to the CPA. That'll be super helpful. Investment activity of all kinds, stock sales, obviously, those are reported. If you exercise any stock options, want to make sure CPA gets that information. If you participate in any employee stock purchase plans, if you've had any Roth conversions, if you have any kind of capital loss carry forwards, all of those things. Want to make sure we get our ducks in a row and include that as part as what you'll provide to your CPA. Obviously, charitable giving, you want to make sure you document that really well throughout the year. And as you're getting everything together for your tax advisor, make sure to include any cash gifts, receipts, if you made any contributions to donor advised funds, any non-cash contributions. Make sure you've noted those and you have any applicable values, fair market values, and of course, qualified charitable distributions. If you process those through us, we'll have those letters on their way very soon. We like to outline those for you. But if you have any of those coming from anywhere else, you want to make sure you take good note of that and give that to your CPA. Any of our business owners, income, expense summaries, mileage logs, any asset purchases, anything along those lines, you want to make sure you include. Confirm payments. So obviously, most of you are tracking on any of your federal and state quarterly payments that you've been making, any adjustments to those, any refunds from last year, any withholding, document it all well. And last but not least, credits and deductions. So any education expenses, energy improvements to your home, any electric vehicle purchases, you want to make sure you've got all that documented, childcare costs, and contributions to HSAs or health savings accounts. All of those are important to include. So as always, we like to say, if we can be of any assistance as it relates to the preparation of your 2025 returns, please let us know if you have any questions on the tax documentation you receive from us. We're here to help. And if you need to put us in contact with your tax professional, we're happy to do that as well. We're just a phone call or an email away, but we want to do anything we can to make this time easier. So please don't hesitate to reach out.
Thank you, Jen.
Yep.
One point of note there too is that if you are in need of a tax preparer or a CPA, we can help make an introduction for you as well. We don't file taxes for our clients, but we are definitely involved in the tax strategy and interfacing with your tax professional. So just let us know if you need help, and we'll be glad to point you in the right direction. Now, key takeaways First of all, we're cautiously optimistic. We realize this has been 3 years of a bull market, but we still believe there's room to run. We are looking at earnings expansion coming from growth in earnings, not necessarily multiple expansion, and that is what is fueling this bull market. We think there is still room to run, and that is for equity investors. Most of our clients have a growth first objective, so it's important for them to buy those companies specifically focused in tech, industrials, and energy as those top 3 sectors. Now, having said that, the last negative market was in 2022 for a full year, that is. We did see negative returns in April of last year. So it's not a matter of if the market goes down, it's just a matter of when. And we've always believed in not betting against America and the good companies in America, but investing in them and thinking like an investor, not a speculator. So buy good quality companies and diversify. We think you'll be all right over time. Which leads me to the second point, is reviewing your cash position. Tara alluded to in her talks about things to be thinking of at the beginning of the year, and adding up your spending is one, but also adding up your cash. We found that a lot of clients do add up a large cash position, not by design, but just by default. They're not spending all of their income. And this cash now is earning less interest than it was a year ago at this time. And that's a concern because of inflation and the value of your dollar going down over time. So it's a great opportunity to review what's coming up in your life for the next year or so. And let's talk about how much you should have in cash, but don't just let it be a default amount that stays there, or you're trying to play it safe. You could go broke playing it safe, quite frankly. It should be added to your financial plan in a way that makes the most sense for the goals that you're striving to achieve. So now's a perfect time to do that. The third thing is rebalance concentration risks. Now, we sent all of our clients an email last week and went through the process of rebalancing back to target. And we continue to do that as an ongoing part of our management of your portfolio. But it's also important to look at other assets that you might have and rebalance away from any concentrated positions, including cash. And lastly, let's maintain a long-term outlook that I spoke of. Historically speaking, looking in the rearview mirror, investors have done very well owning good quality companies in America and benefiting from the growth of those over time. And this is in a diversified portfolio where quality has been measured by a professional and selected and curated for your own benefit. So maintaining a long-term outlook, well, what does that mean? Well, it means that you're thinking about growth for longer than 5 years at a time. Anything short-term, say a year or two, that should be in cash or CDs. And that's a goal that you would need to use those funds for that specific goal. But longer term, it should be in a growth allocation for you. And we say here that it's generally 2 negative years of results out of every 10-year period of time. So you've got 8 good years, 2 negative years, and we weather the storm by diversifying for you. So we're cautiously optimistic, and we think that this year should be another good year for investors. J.A., you can back that up with some biblical wisdom and truth too, I bet, right?
Absolutely. So this is how we close out our webinars, always with some biblical wisdom and truth. And this today we have from 1 John 3, starting with verse 11. For this is the message that you have heard from the beginning, that we should love one another. And then jumping down a few verses in between there, it talks about the example of love that we see in our Savior Jesus Christ. And then verse 18, little children, let us not love in word or talk, but in deed and in truth. And you've all heard probably actions speak louder than words. It's something it comes up regularly with me interacting with my kids. And For us here at Atlantic Wealth, one of our 6 core values is integrity. It's the value that we happen to be highlighting this week. And one of the definitions of integrity is the state of being whole or undivided. And so, are we lining up? Is what's coming out of our mouth lining up with our deeds and truth? And for us as Christ followers, our measuring stick is not looking from side to side to those around us, but it is looking at Jesus, who was our perfect example. None of us can live up to that. So we all fall short, which is why we all desperately need a savior in Jesus Christ. And um, it doesn't stop us from striving after that though, and seeking him in that. And God's word is our absolute truth that is there to teach us and to lead and guide us. So it also, this verse, not loving in word or talk but in deed and truth, really is how we want to come to work every day and serve you guys, serve those that we work with. Is It's not just talk words that are coming out of our mouth, but we back it up in our actions and how we live out our lives. Yes, at work, and how we serve folks, but also beyond. Um, and so we're thankful for that opportunity. And with that, we do want to thank you for joining us today. We are so happy to serve those of you that are clients. If you are not clients, we would appreciate the opportunity to have a conversation with you. We do that with just an initial phone call. So happy to set that up. If you're a client and you have loved ones, friends, neighbors, coworkers, family that would benefit from a conversation with us, we would be happy to schedule that as well. We do enjoy helping folks, and this is where God's placed us to serve, and what a privilege it is for us to do that each and every day. So we welcome the opportunity to continue to do that with folks as we go forward. As Greg said, this is our first webinar of the year. We do have a few others on the calendar, so be on the lookout for that. As well as once we get this approved through compliance, we'll be able to send this out and you can share it with anybody that you know that wasn't able to make the webinar today. So we do appreciate all of you and hope you have a great rest of the week. Thanks so much.
Bye-bye.
Hi.
Bye.